Hello, I'm David Frazier with Investors Monitor, and this is our weekly Wall Street Wrap Show where we strive to tell you everything that you need to know, but nothing more, regarding factors and developments that are likely to affect the value of your investment portfolio. We're recording this week's show on Saturday, January the 9th, broadcasting at 8 o'clock p.m. Eastern Time. And a real quick note, starting next week, we're going to produce our show on Sundays of every week at 6 o'clock p.m. instead of Saturdays at 8 o'clock p.m. And the reason being is really just to give ourselves a little extra time to make sure that we do thorough analysis of the most recent economic and geopolitical developments from around the globe. So let's get started. Well, as I'm sure you know, stock prices around the world fell sharply last week. Some of the bigger declines were in China and here in the U.S. stock market. In fact, the Dow Jones Industrial Average closed down 1,079 points this past Friday as compared to the prior week's close. That was down 6.2% in 1 week. And the broader S&P 500 index closed down 6% this past Friday versus the week ago. Now, we're not the least bit surprised in this downturn. I mean, we have been telling visitors to our website and subscribers to our free weekly commentary, as well as clients that subscribe to our investment advisory journals. We've been telling them since May 6th of last year to allocate a very large portion of their financial market assets to cash-like investments, such as money market securities. In fact, we told our clients to get completely out of stocks on May 6th of last year. That was only 2 weeks before the all-time high in the S&P 500 index. Now, the S&P 500 in other stock markets, and really just stock prices in general, they fell sharply during August of last year. They poured back in June, rallied in July, but then they pulled back again very sharply during August. And although the major stock market indices are really around the globe, but focusing here on the United States, rallied considerably from August 26th to November 3rd of last year, they've been trending lower since then. And we've told our clients and subscribers to both our fee-based and free commentaries. We've told them repeatedly to continue to allocate most of their assets to cash. And it's not because we have a crystal ball here. It's just simply that we do an extensive amount of research on a daily basis. I mean, we monitor more than 100 economic statistics from around the globe. We also monitor on a daily basis the trading action in worldwide financial markets. We look at mutual fund flows. We monitor important geopolitical developments. I mean, we do a lot of homework. And in our homework, that's what led us to tell people to get back out of the markets back in May of this past year. And for those people that did not heed our advice early on, we then told people last Sunday, we told investors last Sunday, both on our internet website and on a free weekly commentary that we issue every week to persons who subscribe to that free market commentary. We told them January 3rd, Sunday, January 3rd, quote, "Stocks headed sharply lower. Get out before it's too late." Now, so the vast majority of these folks that you see and listen to on broadcast financial shows, now what have they been telling people? They've been telling people what they always tell people, to invest in a diversified portfolio and to invest it for the long term, and don't worry about any downturns in stocks. You know, stocks will come back and nobody can time the market. Well, I joke with my partner very often, and I say, well, I guess my name is Nobody, because I'm not trying to pat myself on the back. I'm really not. But we have a very documented history of everything that we tell investors. We document what we tell them. And we told people back during January of 2000 to get out of the stock market. And then stock prices peaked during March of that year and fell substantially over the ensuing approximately year and a half. We told people to get back in the market during October of 2002. And then during September of 2007, we told people to get completely out of stocks. Once again, in fact, we advised our clients to sell stocks short during September 2007 and to maintain those short positions through October of 2008. Then we told people to get back in the market again during late April of 2009. So, we don't expect to be able to forecast the direction of stock prices in the very short term on an hourly, daily, or even weekly basis, or even monthly basis. But we have been very good at accurately forecasting major turning points in at least the U.S. stock market. And one thing I urge all of you that are listening to and watching this show to think about very seriously. Just think about very seriously the following. The vast majority of so-called experts that you see and listen to on these broadcast financial shows, they get paid indirectly to a large extent by the amount of money that they keep invested in the financial markets. So, if some portfolio manager tells you, well, no one can time the market and we invest for the long term. Well, of course, they want to keep you in the markets at all times because that helps them to increase the money that they make. It's just a fact. So I urge you very strongly to keep that in mind. In contrast, what we do here at Frazier and Mayer Research, LLC, the providers of Investors Monitor, is our focus is to help investors to avoid the big downturns in the worldwide financial markets and to participate in the majority of the upturns. So we get paid really, instead of keeping people fully invested, we get paid really for whether we're right or wrong for the most part. I mean, we're going to be wrong. We've been wrong in the past, we'll be wrong again. We don't get everything right. Not all of our individual securities recommendations work out, but we have been very good at forecasting the major turning points in the markets. And this is why, based on the research that we do on a regular basis, we told people to get mostly out of stocks during May of last year, and then when we sent out this email last Sunday and told people that to get out before it's too late. So, okay, that's all in the past now. Those of you that subscribe to any of our services, hopefully you've heeded my advice and hopefully you are primarily in cash. I realize that a lot of you listening to this show probably rely on, to some extent, income from your investments for your living expenses. And we have recommended for the past several years, allocations in certain income securities that tend to be relatively safe in terms of, extremely safe in terms of almost no default risk, and really very little price risk, very little market risk, that pay some relatively high dividend income. So if you don't know what I'm talking about and you'd like to hear about those securities, send us an email. Just go to our website at www.investorsmonitor.com, and there's a link on the bottom of every page of our website that reads "Contact Us," and you can click on that and send us an email. So where are we headed from here? What should you do now? Well, if you have been primarily in cash, we advise you to continue to stay primarily in cash. And I'll tell you why in just a moment. If you haven't been primarily in cash and you're still holding a lot of stocks, a lot of your total investments in stocks, I would urge you, or I do urge you, to not get out on Monday morning this coming week. And I say that because stock prices in general, and right now I'm focusing primarily on the U.S. markets, as measured by the major stock market indices. They fell to some major price support levels last Friday and held near those support levels. Number two, price momentum statistics for the trading action in the U.S. stock market indicates very strongly that stocks in general closed last Friday at oversold levels on a short-term basis. And when I say oversold levels, meaning that even though there were good reasons for stocks to sell off, that a lot of people likely got really scared and just got out at any price and pushed a lot of stocks to levels that during the immediate term is probably lower where they should be trading. And therefore, my research and experience and indicators that I monitor on a regular basis indicate pretty strongly that stock prices in general are likely to rebound a bit during the week ahead. Now, however, longer term, and I don't mean 10, 20 years, some of you aren't going to be around, very sadly, 20 years from now. And, when these folks tell you to invest for the long term, well, what's the long term? It's interesting. They almost never define the long term. They never want to tell you that. They just want to keep it in the markets. Well, when I say the long term, I mean a period of time that I feel comfortable in being able to accurately forecast, because I've done so for about 15 years now, and that's a period of approximately 6 months to 18 months into the future. And our research here at Frazier Research, LLC, suggests that there's a very good probability that stocks in general are going to continue to trend lower over the next 3 months and possibly even the next 6 months. Well, of course, it's always possible, but a high probability that they're going to continue to trend lower for the next 3 months, and a relatively high probability that they'll continue to trend lower for 6 months. So, therefore, you need to stay out of stocks, and if you haven't gotten out yet, wait for a hopeful rebound this week, and then reduce your allocations to stocks. And the reason I'm saying this is what I've been telling our clients for many months now, and that is, without getting into a lot of detail, is that numerous leading economic indicators from around the globe, here in the United States and in most other countries around the world, indicate very strongly that the pace of economic growth in most regions of the world is going to slow considerably over the next few months. Well, if the pace of economic growth is going to slow considerably, that means that companies in general, and there's always exceptions, they're probably going to have fewer sales, and therefore they're going to generate lower sales revenues. And in the relatively short term, it's difficult for companies to cut their costs during a period of just a few weeks or a few months. They often have long-term fixed investments that just can't reduce their expenses substantially in the short period. So if revenues do turn lower and their expenses stay relatively flat, well, what does that mean? It means their bottom line profits are going to likely decline, or that they're going to even lose money. And stock prices are, both the level and direction of stock prices is ultimately determined by the level and direction of corporate profits. And we already saw profits decline, not just slow down or turn lower, but decline on an aggregate level here in the United States for U.S. corporations during the most recent reported 3 months into September 30th this year. So we're, to keep it simple, a lot of indicators are suggesting very strongly that we're going to see a slowdown in economic growth in most regions of the world. So therefore, I'd advise you, once again, those of you that are in cash primarily, you should stay in cash for a while. And if you're strongly allocated, highly allocated to at least growth stocks anyway, my gosh, you get out if there's any rebound in stock prices. And once again, if you're looking for some income investments and you're not familiar with the ones that we've written about and have recommended to investors in the past and are currently recommending, just send us an email. So I'm going to keep it at that for now. I thank you for listening and watching. Once again, our goal is here on these weekly shows is to tell you everything you need to know, but nothing more. And hopefully we do that on a regular basis. So I thank you once again, and I will speak with you again next Saturday.